Hello, everyone. Firstly, let me say it's a great pleasure to be here today at this conference and also to introduce this next session and indeed the panel to talk about capital markets. I work at Goldman Sachs, based in London, and I look at capital markets and equity markets globally in particular. And I thought I'd spend just a few minutes giving a very brief summary of some of the major drivers that we see looking at capital markets, and in particular some of the differences in the drivers between the developed and the emerging economies. Firstly, if you look at this table, which has a lot of numbers on it, this is showing the forecasts that we have for some of the major regions of economies over the next 2 or 3 years. And there are a couple of points I think are worth really emphasizing here. One of them is that if you look at the global forecast that we have, by next year we are expecting growth to be back to about 4%, and then to increase in 2015 and 2016. And this is an important point because this suggests that global growth by next year should be pretty much back to trend. A lot of this recovery is being driven initially by the United States, also to some degree by Japan as a result of its very aggressive and supportive monetary policy. We see some recovery in other emerging economies. Europe doesn't really grow very much. It doesn't contribute much to the global economy, but it does benefit a lot from it as well. So global growth, we think, will pick up. At the same time, however, we think that inflation globally is going to be very low and come down in some countries, as we've seen here in Poland, but also as we've seen in the United States recently, China and beyond. And that means that the policy setting, despite the recent concerns about Fed tapering, is likely to remain very accommodative. And if you look at this chart, which shows financial conditions or a broad measure of monetary policy, in the dark line you can see this significant easing of policy that we've seen just recently in Japan and generally across the G4 countries. Also a significant easing of monetary policy. We think this will remain in place, and that should be pretty supportive for riskier assets. Now, when we think about the difference between emerging economies and developed economies, one of the interesting perspectives is that the output gaps or the excess capacity in the developed economies, which you can see on the middle blue line at the bottom, is much bigger than it is in emerging economies, which have generally been growing much closer to trend. The result of that has been much easier monetary policy and interest rates generally in developed economies than emerging economies, and that's had a little bit of an impact on the relative performance of DM and EM. Generally, riskier assets like equities have done better in the developed markets as policy has been eased much more aggressively than in the EM markets. This chart, which is a little bit complicated, just shows the general direction of cyclical growth in some of the major emerging economies. These are showing the PMIs, the Purchasing Managers' Indices, that give us some broad measure of cyclical industrial growth. And it's worth noting that if you look at the period from 2011 and 12, generally these economies were holding up very well when developed economies were very weak. But just recently, in the period in the last year or so, these two have been weakening. So when we think about DM and EM, what we found is, of course, that in general, emerging equity markets have significantly underperformed developed equity markets over the course of the last year or two, reflecting largely the difference in this policy setting and also the cyclical dynamics in activity. But in terms of the major message, I think, moving forwards, the broader picture of an improving global economy with still low inflation and low interest rates is pretty supportive for an ongoing recovery in capital markets and risky assets like equities in particular. If you look at this chart, which shows for the US, the relative performance of equities versus government bonds over 10-year holding periods, going back over 100 years, you can see the backdrop here is one of significant underperformance for equities, which has lasted a very long time. The recent 10-year periods have actually generated the poorest relative performance of equities compared to government bonds in more than 100 years. And this poor performance started before the recent financial crisis and provides the basis of attractive valuations now in equity markets generally. These attractive valuations are reflected in low PE multiples, high dividend yields, and high risk premia. The higher the risk premia, the better the prospects for future returns. And when we look here at our measures of risk premia in European equities, for example, you can see how high they have been relative to long-term history, because people have been so uncertain and so concerned about the prospects for growth in Europe, the euro, and the general financial crisis. But gradually, as these fears fade, the prospects for equities become very much better, and we see an ongoing opportunity for further appreciation in equity markets more broadly. We can also see that if we compare these valuations, for example, in equities versus corporate bonds, this chart shows that comparison. The higher the line, the cheaper equities are relative to corporate bonds. You can see that there's a very big relative opportunity here as well. So through the crisis of the last few years, investors have been sitting in cash or in government bonds. Gradually, as they've demanded more income, they've moved into the corporate bond markets, and that's made corporate bonds expensive relative to equities, and that's really left a big opportunity for equities to recover from a valuation perspective. And you can see, for example, again, in the case of Europe here, the proportion of companies that have a dividend yield above the corporate bond yield is at an all-time record high. Again, this is a very interesting signal of relative valuation, which suggests to us that equity markets will provide the best opportunities across asset classes as we move forwards in time. And finally, I would say that despite the recent underperformance of emerging markets in the context of this global financial crisis, the longer-term opportunities for growth still look extremely good. This data collects for each decade the overall growth rates for the global economy. And as I said, despite all of the recent worries and concerns, the decade from 2010 to 2020 is likely to be the peak decade of global growth. And if you add up the various different emerging economies' contribution to that growth, it's really very significant, around about 75% or so. So although we have seen cyclical weakness recently, concerns about policy tightening in emerging markets, the longer-term perspective and opportunities for growth still look, I think, very good. So the main points, I think, really are quite a positive one. We do see a recovery in the global economy. We expect continued low inflation and interest rates. We see lots of valuation opportunities, particularly in equities. And I think the longer-term prospects for emerging economies, despite recent weakness, continue to look quite positive. I'll finish my comments there. Thank you.
Thank you for this introduction. Mr. Peter Oppenheimer will stay on the stage. You can take your seat. And the discussion on developed versus emerging markets will include Mr. Adam Maciejewski, President of CEO Warsaw Stock Exchange. Welcome. Mr. Jose Martin Soares, Head of Emerging Markets Research, Espirito Santo Investment Bank. Ms. Iwona Sroka, President and CEO, Central Securities Depository of Poland.
Hi Peter, I'm Jose, nice to meet you.
The floor is yours. And Mr. Paweł Tamborski, Under Secretary of State, Ministry of Treasury, the Republic of Poland.
Nice to meet you, Iwona.
And the moderator will be Ms. Luisa Boyesen, CNBC Europe. After the break, after the discussion, you will also be encouraged to ask questions. Thank you. The floor is yours.
As always, as always. Hello, everybody. Welcome. I wasn't being unpolite. I've said hello to all these lovely people before we got on stage. We've had nice discussions, most of us, and I very much look forward to the next 45 minutes or so in your company. Not 2.5 hours, 45 minutes, yeah? We'd love to have questions at the end of it. As said, my name is Luisa Boyesen. I work for CNBC Europe. I'm based in London, and I've been covering the markets and anchoring the shows for 13 years now. So everything that moves the markets, I need to know a little bit about what's going on, and it's great fun, but it's fantastic to be let out of my cage and to come here and actually do some one-on-one talking and to feel a little bit about what's taking place in some of the economies that we don't typically on a day-by-day basis look at. And Poland, to me, is super interesting, because it's a market where, for many of our viewers, unless you know about it, you don't know about it. And I was saying, I mean that with the utmost respect. I'm Danish. It's a small market. Many viewers don't know enough about it. And part of it is also an education process about where do you see opportunity, because I know a lot of people, a lot of investors, they would love to be more present in some of these so-called emerging markets. Whether or not Poland is emerging or the Polish market is emerging, we can discuss that in more detail too. But my panel members here next to me, you had an introduction coming on stage. Just to repeat who is here with me. Iwona Sroka, President and CEO of the Central Securities Depository of Poland, sitting here in the middle. Paweł Tamborski, the Undersecretary of State for the Ministry of Treasury of the Republic of Poland as well. Adam Maciejewski, the CEO and President of the Warsaw Stock Exchange. And Jose Martin Soares.
Long name.
The Head of Emerging Market Research for Espirito Santo Investment Bank, and Peter Oppenheimer just giving us that tremendous presentation there, just what's taking place through the eyes of Goldman Sachs, the Chief Global Equity Strategist for Goldman Sachs. So I'd love to just have a couple of minutes from each of you. Not sure if you want to go again, Peter, since you just spoke, but at least from the rest of you, just a few minutes, about 3 minutes on how you see the emerging market landscape at the moment compared to developed markets, and especially with an eye towards Central and Eastern Europe and Poland. Maybe we could start with you, Adam.
Thank you, Luisa. So we heard a lot about emerging markets today, so it's not easy to add something fresh, something new, but definitely we should try at least. So maybe I will rather focus on Poland, as we are in the center of Europe, in Poland, so commenting on Polish economy, Polish capital market, it's, I think, right place. And right idea. So, in general, what we observe, not only on in developing countries, in emerging countries, but in general, it's something that some people say great rotation from bonds into equities. And I'm sure that it already arrived into Poland. So this appetite for risks definitely bigger than it was just a few months ago. So it seems that we are in a we are in the right time to think about investing in equities, in companies, not just in very safe investments as it was for last several years from 2008, definitely. What else? I see also a big shift of investments into ETFs. Unfortunately, these ETFs are not present on some emerging markets. And example of such region is definitely Central Europe. Currently, it is obvious that such investments in ETFs are a very wise way of investing money. You have big diversification of your risk, and it is simply cheap. We've been trying to introduce ETFs into Central Europe, into Poland, for 5 or something, for 5 years or something, but we are not successful yet with this. So it is something that I see the potential in emerging markets to introduce ETFs as an alternative investment comparing to direct investments into equities or other asset classes. So it's something that we are still missing.
And maybe I could just stop you there, because I want to get back to some of the points that you've just brought up, and then we'll have a little bit more of a roundtable discussion and perhaps include some of you in it as well. Pavel, some of your initial thoughts just heading into this discussion.
Sure. Initial thoughts are about confusion, actually. Confusion, yes. So
that's the middle name that I bear every day.
Yeah, so I'm a little confused, especially when I'm thinking about, is Poland already, slowly but surely, approaching, let's say mature, less emerging, but mature areas, or are we still, in our well-known for us, area of actually emerging markets? So on one hand, you have, growth rates, which is actually these days actually on the level of rather closer to the mature markets, on one hand. On the other hand, maybe not on our hand, but in addition to that, we are already part of the European Union, and to be honest, sometimes, my feeling is that, regulations of the European Union don't help us in actually being more emerging, sometimes, more dynamic. This is on one hand. On the other hand, when I see the statistic of our recent transactions, of our recent privatization transactions, so majority of demand is coming from emerging market pockets. So we are still mainly on the radar screen of emerging Europe and emerging market investors. To be honest, I don't know yet. So should we, or do I want really? Me as a Paweł Tamborski now, person who is not only acting as a member of administration, but as an investment banker, Poland to become part of the mature markets. Should we rather try to stay in this emerging area, which we know and which we understand?
Excellent. Some very good points again.
Confusion.
Maybe I should just ask us all to be an adjective. Ivona, please, your initial thoughts. Are you confused as well?
Okay, so thinking about the foreign investors' main decision to get or not to get to that emerging markets, I think that they are firstly looking for a strong and liquid market, especially with many asset classes to ensure diversification. And I think that in our case, we have that wide range of classes, but we still are looking for a liquid market. And we also have strong and attractive companies and new listings, which is our trademark, especially in the region. Because when you think and then you look on different countries from the region, so Poland and the stock exchange in Poland is the leader according to the number and the value of the IPOs. But when you think about develop and the potential of develop and potential of emerging markets, I always think about the questions. What is better, to be a big fish in, you know, that sentence about
Big fish in a
the
small
pond,
sea
yes,
or
or the
small fish in a big-
yes. So you have two main factors. When you are in a big pond, you have also a big competition exposure. When you are in the smaller pond, you have a smaller competition exposure and still a bigger potential for growth. And I think that still being in that so-called advanced emerging markets and waiting on that watch list, it means that Polish market is still waiting for that upgrade to developed market. There are lots of advantages, like lower competition exposure. Well, we are still behind that competition with MTS and especially OTC markets, and potential for growth. Especially that yesterday we have also a decision, we had a decision of the National Bank of Poland to lower interest rates, which is a sign that they want to stimulate economy. So I think that the prospects for that emerging markets and for our market will be better than yesterday.
Brief, do you think they'll cut more? We're at what, 2.75% now? Don't know.
I have
Don't know.
2 more minutes.
Well, we'll think about it. We'll think about it. Maybe we can talk about it. Last but not least, initial comments.
Well, I share some of the confusion that my fellow panelists. Thank you for the opportunity to come here. I come here very often to Poland. It's and I remember always the story, just to pick up on Iwona's point. When I started in this business, I'm no spring chicken, even though I think I look remarkably younger. I started in 1996, and
They
my
all think
country.
that.
I was 5. And my country, which is even smaller than all of us here, which is Portugal, was an emerging market. So I was really excited. 1986, 1997. Then Portugal got upgraded to developed markets, and went from having 20% in the index for the emerging markets at the time in Europe, for emerging Europe, to have 2% in the developed markets. So you can imagine how much time a fund manager spends with an asset that is worth 2% of its fund. So I think the emerging category got created initially as a more glamorous term to call less developed economies. I don't think that's the case for Poland, but I would certainly leave the emerging market as a category because it's a lot sexier, I would find. Now, the second point that I would make is the more confusion is added by two things. One is, and there we have a good example here, and I'll pick up on my experience in Portugal. You know, one of the largest companies in Poland, one that all of us shop on occasion, called Biedronka, is actually listed in Portugal. It's 4th or 5th largest employer in Poland, yet it's not listed here. And I travel around the world.
We have to change this.
And I travel around the world, and one of the best ways to play Poland is through Jeronimo Martins. It's a company that we like particularly. And it's 94% of its value is in Poland, 94. So it's basically a Polish company with headquarters in a lovely sunny country that we have. So that complicates the way investors look at this. I've been looking at this panel and seeing a lot of people looking at things on a very top-down perspective. And to add to the confusion, what I'm seeing from investors, and I've been doing this for 17 years, is I'm getting more and more the impression that investors are overcoming or bypassing that emerging versus developed market label and focusing on themes, on sector-driven stories, on specific issues from a more of bottom-up approach. Because I will leave it at that.
Excellent. You bring up some very good points, all of you. Before we get into some of those points, I would also just say that the name of the actual panel is Developed versus Emerging Markets, Key Drivers of Future Cash Flows. And what often happens on these panels is we talk about all kinds of other things, and then you leave and you haven't actually addressed the main question or the main issue. So I would also just ask you, do you see a particular area where you think that there's going to be a key driver of future growth? I mean, and it's kind of not enough just to say, oh, the Polish market. I mean, where is growth going to be coming from in concrete terms? And we're all dealing with it now in Europe. We have austerity measures being put in place. The Polish economy has come down quite substantially. I was talking to you about this last night, about whether or not, you know, we had an interview. So we went from we went from 4% growth before the crisis started unraveling, and now we'd be happy with 2 to 2.5% growth, right? So where is growth going to come from? And do we necessarily have to look at the divide that we're talking about, emerging versus non-emerging? Peter, maybe.
Well, I think that there's a lot of potential growth themes. Technology is something that continues to evolve, and whether that be technology in terms of consumer products or energy efficiency, I think that that's going to be a very important driver globally. We also think that if you compare the last decade or so, which was very much driven by the urbanization and industrialization of some of the very big emerging economies, China, India in particular, the next decade or so is likely to be much more driven by broadening out of their growth towards more domestic consumption. And that will be an important driver for companies, whether they're based in Poland or in the US, Spain, Portugal, or anywhere else. I think that's a very big and growing opportunity.
Jose?
I would, we're putting our money where our mouth is, at least from that perspective. We write thematic pieces. We don't have the resources as
you
other
wrote
big
a
firms.
piece on emerging market women, and then you wrote a piece on emerging market food. Both super interesting in terms of potential investment opportunities.
I mean, it's picking up on, for us, the relative growth story is still there, as Peter was pointing out. We may think that Poland is now going from 4% to 2%. I would swap. I would give you back Portugal, Spain, Italy, and a little bit of France, and I would swap for the growth that you have here. Plus the dynamic of the population, the age difference, the consumption growth, et cetera, et cetera. Now, we've identified women in emerging markets as a key driver for future growth, always with the prospect of recommending ways to play that to investors. That was one idea. The other one is food. 80% of the expenditure in a lot of these emerging markets going forward is going to be on food as well. How to play it is a little bit different, because sometimes the economic reality is different from what you can play in stock markets. And picking up on what Adam was saying in the beginning, and what the former panelists were saying, the fact that we don't have big companies listed in Poland or coming to the market, it's a little bit irrelevant, because Poland can be a hub to attract smaller companies from within the region, whether it's technology, agro, consumer, retail, et cetera,
But they don't
to list
only
here.
want small companies.
We love
You
small.
want the
Small
big
is good.
ones too, right? The big companies, Adam. That's what you want to attract with the stock exchange, and we want to see more listings of bigger companies too. You have a zillion, quadrillion IPOs, and many of them, not all of them, but many of them are in the smaller sizes.
Yeah, you are right. But before I answer this question, maybe I will comment what you raised before. First of all, I couldn't agree more. As for the last night, it was exciting, really.
We're airing the interview, I think, tomorrow, so you can watch it tomorrow. Yeah.
Okay, but as the drivers for growth in developing countries, in emerging countries. First of all, I think that this potential for growth is not equal among developing countries. The biggest potential I see, and I have no doubt, is in big economies. Economies measured by number of people, by the population. And the average, what already was said today, the average age of population as well. So in general, in demography, So big countries have really big potential for growth. The next one, it's rather obvious. When you look at GDP per capita, we are much lower than average. For example, in Poland, we are at the level of some 60% of European Union average. So this is natural potential for growth. And the last, but not least, is that we are still hungry for success in these countries. So we are looking for new opportunities. and thanks to this we can work hard, and this is real potential. It's nothing especially sophisticated. It's very easy, yeah? We want success, we are looking, we are willing, and we are simply working to have such a success.
So I would like also to add something. You must remember that our market economy has only 20 years. So we really
Speak a little bit closer
yes.
to
So our market economy, we just only started almost 23 years ago. So it was a real milestone to be a leader in that region, even in comparison to, for example, Austrian market, which is
It's a very good point.
comparison.
Yes.
So that's why we have smaller companies, because they are pretty new, they have a short history, but they are innovative and dynamic. So that's why this is our asset, that dynamic. And I think that in the next 10 or 3 years, the next one or second decade, we will also have big companies like Nokia, like Coca-Cola, or other...
Nokia is not a good example.
Yes, it is not good not example, yes. But it was in the past a very good example, one big company on the... Apple. Okay, let's have Apple. But I think that everything is before us. So this is the difference between old economies and that developing economies, especially from that region, post-communist region, that we have a big potential for growth.
You wanted to come back.
Yeah. I want to comment this small and big companies phenomenon. Yeah, of course, the businesses in big liquid companies. That's obvious. Yeah, everybody is looking for business, for liquidity, for big companies, and that's also the case of Poland, of WSE. But we should think in a bit longer term, not only, just in 12 months, if we meet our budget or not, yeah? We should think at least for 5-10 years ahead, maybe even more. And that's why we decided in Poland to invest in these very small businesses. On different levels. I would rather focus on WEC, not on the policy of a government. But in case of WEC, we decided to start this New Connect market a few years ago. And many people ask, what are you doing it for? Yeah? Does it create big revenues? Is it a business for you? Of course, it's not a business for us just now. It will be a business for us in 5 years, and not only for us, but it will be the business for the whole capital community in Poland, and I hope not only in Poland, but in the whole sea region.
Paweł, last but not least, in terms of where you think that the future drivers of cash will be.
Future drivers, I think that, we're talking about growth here, yeah?
Growth, cash, yeah.
Yeah, CE has to grow, actually. It has to grow faster. We have to run faster. So people living in this region, we have to, on all levels, yeah? So we have to grow faster just to catch up old Europe, actually. And I think that this is probably the simplest. As long as administration will be at least neutral or not helpful, so it should be as well helpful for the growth of countries. I think that there's also, especially maybe less for Poland, but more for other countries. Actually, this is also, especially when we are talking about large companies, which are still in state hands, for example. Yeah? So privatization is also some kind of source of simple reserves for growth. Yeah, so we observe this on cases of our companies, of course, as long as we are shareholder as a state. So sometimes it's difficult actually to motivate this company to act really, in an effective way. After privatization, you can see that this is like butterfly. Actually. Yeah? So sometimes these companies could fly, and I think that we are talking about simple reserves which are still available in this region in Poland as well.
So Peter, when you sit at Goldman Sachs and you look at the Polish market, would it make a difference to you if there was a nice consolidation between some of the bourses involving Poland and some of the bourses around, say Vienna, say the CEE grouping?
Well, I think that particularly in the environment at the moment, people want liquidity. And liquidity and volumes have been very low, even in the biggest exchanges in recent years because of the crisis and because of transition to things like ETFs that we heard about earlier. So anything that makes capital markets deeper and more liquid, I think is very attractive for investors and will open the opportunity up to a bigger range of different investors around the world.
Because you look at the competition that's taking place now, or that has emerged in Europe, in Western Europe, and some of the tie-ups between some of the big exchanges. And I mean, we spoke about this as well, Adam, and it does seem like you're moving slowly towards potentially entertaining the thought of some type of an alliance. And that might make a difference in terms of growth. It might not, but it might. Or attract foreign investors or domestic investors as well. And liquidity, increased liquidity.
Yeah, there are definitely two alternative ways to grow for such a market as we are. Not only for such a market, for every exchange. The first is way to grow, or maybe not two, maybe more. First of all, you have to decide if you are equity exchange or derivatives exchange. Yeah, we are not talking about derivatives today, but this is a phenomenon of some kind of a business that is drastically international. Extremely interesting topic, but I will leave aside it just now, and I will focus on equity. And as for equities, there are two different models of developing exchange and or the local or regional market. The first is to grow in a centric way, I would say, like Deutsche Börse, for example. And this is a very successful model. If you are a strong market, if you are big enough and strong market. If you are not big enough, then there is a federal model of cooperation of exchanges. And one of such examples is definitely CSEC Group, Vienna, Prague, etc. In a bigger scale, Euronext is something almost the same. Yeah. We as WSE are asking ourselves which way should we go. If we are big enough to attract business to Poland, to focus on local market and regional market, and try to build in the same way as Deutsche Börse, or should we enter into kind of alliance? Should we merge with anybody and focus on building federal model of exchanges? We have no answer to this question yet. Probably this answer should come very, very soon. I will not predict today which way we will choose, but I just wanted to say that we are just ahead of such a decision that should come in some 1-2 months.
I also want to pick up on another point that was made a bit earlier with regards to asset rotation and whether or not we really are seeing this rotation from bonds into equities that we keep hearing about. And where I sit in London, every single day I hear there's a wall of money waiting to be invested. And then we have a green day, and then I hear the wall of money is being invested. And then a red day, by the way, minus 0.5% lower on the markets. And then people say the wall of money is not there. And I just wonder, what will it take in order to see movement, real movement of some of the money flows that we've seen heading into the bond markets here over the past year, especially in some of the periphery Europe and some of the emerging market bonds as well. And back into equities. I mean, are we ripe for that to happen? Is the hunt for yield really on?
I'll start. Being in equities all my life, my comments about bonds will be always limited. But I do notice something, and I'm on the road with investors very often, maybe a little bit too often. And what I do notice is that there's a price for everything. The risk perception on equities has been, dismal. We have seen private flows coming from the mid of 2012 into emerging markets. That has been good. Poland is a case in point. Our research team here tracks flows in the pension funds and in the mutual funds. So the picture is a little bit rosier. But what I've noticed within the equity side is more of because of this complication in terms of what is really emerging, what is really developed, is there are cheaper ways to play emerging market growth through some of the developed market companies because they are exposed to the markets here. And I've seen that because sometimes because of the scarcity of availability of stocks in markets like Poland or Turkey or the Czech Republic, and not to mention South Africa or India or Brazil where we are present as well. But we are seeing European developed stocks with exposure to emerging markets becoming favorites again, and people looking at the nitty-gritty.
Ivona, what are you observing from your side of...
So I'm not good in investments, but I must say that investors, especially looking for one unified market, and I think that you mentioned about that integration, it would be of course very good from the point of view of international investment in shares, in bonds, equities, and other instruments. So consolidated capital market in the region is okay, but it should be cheaper, and I know that that process is very complicated. So creating a potential hub for international investors with one trading floor, one central depository, and one CCP, it's a very difficult problem, especially when you don't have an economy of scale. Because, we are talking today about the growth and the potential. The potential, the growth is huge. But of course, still, we have a small scale, economy scale. We have a lack of that economy of scale.
Yeah. Well, I mean, we all have to start somewhere, right? And I guess just recognize the way it is. Paul, would it make a difference, do you think, if Poland were a member of the euro? Because I spoke to your Prime Minister, Donald Tusk, this morning, and he was saying he still is looking to, I know that there are lots of internal strife, I know the political scenario, I know, but I did ask him about the euro, and he said that he was still looking to join the euro, but given that you're so export dependent on Europe, it makes sense to see more of a recovery happening in Europe before pushing ahead with an aggressive stance on we want to join now, today. But would it make a difference to how, I guess, the perception is of investing in Poland and to the growth story if you were a member?
For sure it will limit one of the risks, actually, which is currency risk. And I think that, this could help some investors actually to come to Poland and to spend, to invest in Polish situations, not only equity but also debt and maybe as well, in the form of foreign direct investments, actually, especially for the third one probably. Yeah? And this is something which we already observe because what keeps us busy in our ministry these days is finalizing of our Polish investments program, so facility which should actually invest in Polish infrastructure, and we are talking to a lot of investors who are usually involved in infrastructure, and they said that one of the important factors for us is actually FX risk. Yeah, so for sure it could help. Yeah? So. For sure, Prime Minister knows better, but I think that our answer for Eurozone and Poland accessing Eurozone is that we would like to become member of Eurozone when Eurozone will be ready for us. Actually, so this is probably
it will be
our
also
target.
easier from that point of consolidation, because when you have a different currency, look at that. For example, CSDS Euroclear, they have two entities in Great Britain for the British pound and also for the European side. And the same as clearing houses, CCP. you have to diversify, you have to stay with your local currency, and what about euro, what about the liquidity in euro, forint in Hungary, or British pound in Great Britain. So this is also a kind of barrier for local market, and as I understand British, because they have a great market, so this is a kind of barrier just to keep the money and keep that seat in London.
Let alone Denmark, who refuses to join the euro.
Well, what we do is we just have a referendum, and then they vote no. Then we have another one, and then they vote no, and then another one, and then they vote no, and then until they vote yes, right? That hasn't happened yet, but yeah, maximum 3. So we've had 2. I think we should open the floor to questions, huh? End of the day, you've heard some interesting viewpoints. Any questions out there that you want to know? And I think we have a microphone floating around somewhere as well, here. Yes, please. And just tell us who you are, and just stand up, because it makes a better impression.
My name is Nao Kami. I'm originally from Japan, but I have a company in Switzerland representing SB Capital. We look after a few family offices from Japan. I have a question for you. I've been investing in Poland for some time, but only through ETF, because there's no registered fund in Luxembourg or Dublin. I mean, other East European markets like Russia, other places, I can find such, but not in Poland. Why is that, and is it going to change?
Now you've got
It's
it.
time to answer why not ETFs in Poland yet. Yeah? It's not completely true that we do not have ETF in Poland. We have ETF on our Week 20 index. It was issued by Lyxor. You can buy it on WSE. But definitely it's not liquid enough, because assets under management in this ETF are, as I remember, between 50 and 100 million euros currently. The question is why, yeah? To be honest, it's not easy to answer this.
Not the question I asked.
Yeah?
I cannot find any fund managers in Poland that is registered in a foreign country like Luxembourg or Dublin. I may be able to find something in Poland, but not outside.
Okay, so sorry, I thought
I'm not talking
you
about
mentioned ETFs.
Yeah, I have ETF listed in US.
Mhm.
Right, there are 2, right? But not fund, Polish fund managed by Polish fund managers, that I can buy this fund outside your country.
So probably it's not the question to me.
There must be some regulations, right? There must be some regulations.
You're asking why they don't exist outside of Poland, so you can buy
But I
into
must
Right.
agree with you, if I understand, that we attract foreign investors, foreign capital, foreign institutions, financial institutions, but there are no flow in the opposite side. So our brokerage houses, investors are not interested in investing abroad or just to offering some products abroad. So I must agree with you, but I think that this is the level of the development we have lots of to do.
I hope that partly answered it then, yeah?
And how it's going to change? This is, yeah.
I think, well, over time maybe, or
Time.
opportunity?
Over time, I took notes, actually. So, yeah.
Well, good, that's also why you're here.
Government
right?
is
So,
listening.
yeah. Other questions? Investment opportunities. You're all doing really well. You all know where to invest. Excellent, good. I don't. Oh, there is a question right here.
Now that they've dimmed the lights, we can see a little bit.
Good afternoon. Thank you for this wonderful conference. My name is Greg Fishman from Foil Securities. I actually work in Ukraine a lot, so you guys are very advanced for us. I have a very simple question, and it concerns your pension reform. It's sort of an elephant in the room, and different people have different levels of concern. I myself, I think you would agree, view it as a potential threat to the capital markets in general. You've been very well served by your pension system. And I guess I'll just leave it as an open-ended question. What do you see as happening in your pension reform? Thank you.
Pension funds hold 14% of the listed Polish stocks and are supposed to be investing around $3 billion this year. So if the reforms happen, how detrimental would that be?
I'm afraid it's a question to me, actually. So I have no good answer yet. Yeah. I have no good answer yet. As you know, the system is under review these days, actually, these weeks. Our government will publish the report soon. And the review is done according to, because it was said actually it says in the law. Law says that the system has to be reviewed. We have to take into consideration a few elements here. Of course, all ministers were involved in giving input into this report. As you can imagine, Minister of Treasury, which is responsible for privatization and for development of capital market, we of course underline the role of pension funds in the past and now in our transactions in privatization, but also in the development of capital market in Poland. However, this was in the past really, this element of demand created here locally was really in the past something which made change. Yeah, so this was really something which made change for Warsaw as a hub of capital markets. But in addition to that, in parallel to that, we were able to develop, other pools of demand, like mutual funds. The Polish retail investors are still very active. And take into consideration what we have to do is to do this review. We have to take into consideration not only capital markets, of course, because in the end we are talking about second pillar of Polish pension fund system. So we have to take into consideration. We have to review how the current structure works within the whole Polish pension system. So this is point number second to be reviewed. And point number three is how the system influenced the public debt in Poland, because so far. It has some negative impact. So you can expect some more concrete information soon. Report is on its final stage of drafting, as far as I know. So I hope that in the next few days or weeks, 2 weeks probably, the market, but don't know the exact date. Actually, the report will be published with some recommendations.
Okay, we're running out of time. Before we end, I think it's a good note to end it on, just in terms of things are moving and things are happening. How many of you have three choices: a lot, not so much, or a little. How many of you think that there would be a lot of impact if the reforms are pushed through, just by show of hands? Like a big impact, that the markets would react quite a lot. Okay, we're kind of going a lot of. Okay, fine. How many of you think not so much impact? Maybe some impact, but not so much. And how many of you think there would be no impact? Okay, so most of you think there'd be quite a lot of impact.
Notes taken. Actually.
Notes taken. Thank you very much. I know that we have more coming right after us, so I want to thank all the delegates on my panel. Much appreciated. Thank you for being here as well, and for your input too. We appreciate it. Thank you.
Thank you. Luisa Boyason from CNBC Europe was the moderator of the discussion. Ladies and gentlemen,